Hello and welcome to Trendlines, a podcast on global affairs brought to you by World Politics Review. I'm Elliot Waldman. Before we dive into today's interview, just a quick reminder to our listeners to tune in again on Friday for our editor's discussion looking at the week's top headlines. As the worldwide death toll from the coronavirus pandemic continues to mount, so does the economic wreckage. Millions more people are joining the already swollen ranks of the unemployed this week, and oil prices continued their historic rout into negative territory. China's GDP contracted for the first time in nearly half a century during the first 3 months of this year, and the International Monetary Fund predicts that the global economy will shrink by around 3% in 2020. Of course, governments around the world are doing whatever they can to contain the fallout. My guest for today wrote an in-depth article for World Politics Review last month outlining what it will take to save economies from the coronavirus pandemic. Daniel McDowell is an associate professor of political science in the Maxwell School at Syracuse University, where he specializes in international political economy. He's joining me now to talk about how governments and central banks are doing in their responses to the virus and what more can be done to ensure a speedy recovery once the health crisis subsides. Dan, welcome back to Trendlines.
Thanks. It's great to be here.
So in your piece last month, you wrote that government's fiscal and monetary interventions in response to the economic fallout of the coronavirus pandemic should strive to achieve three criteria. They should be swift, they should be large, and they should be sustainable. You generally gave governments credit on the first 2 points, but you argued that it was still too soon to judge how sustainable they would be. First off, why is this metric of sustainability so important?
Thanks, Elliot, for that question. I think the issue of sustainability matters because, unfortunately, we're nowhere near the end of the health crisis, which is, of course, the root cause of the economic crisis that we're coping with right now. When I wrote the piece for WPR a month ago, I think I was, like many of us, still wrapping my head around what was happening in terms of the health side of things. At the time, there were a range of predictions out there regarding how long this might last, some suggesting a few months, that this may subside in the summer, others suggesting that the pandemic could last as long as 18 months or more. In the piece, I pointed out that if economies are unable to go back to normal for 18 months, then we're going to need sustained government interventions beyond the initial round that we saw. No matter how big that initial response is or how quickly it was put together, it's just not going to be enough if economies are essentially frozen for a year and a half. I think at the time I was still somewhat hopeful that maybe the health optimists would be right. Over the last month, I've become more pessimistic about this. Increasingly, I think it looks as if our economies are going to be in a kind of holding pattern until we get to a vaccine or until there's some effective prophylactic that can prevent folks from getting the virus. And at the moment, we seem to be a ways off from either of these outcomes. So I'll point to three reasons for my pessimism in terms of the length of time that we're going to have some severe economic disruption. So first, we could look to South Korea. South Korea has been widely hailed appropriately as sort of the gold standard in terms of its response to the virus. They have put together quickly a robust test and trace infrastructure. They very effectively flattened the curve. And yet what we know is that recent attempts to reopen the economy have led to a rising number of cases once again. And so this doesn't portend well for the rest of the world. It's plausible that we're going to be going in and out of lockdowns or various levels of lockdowns as cases rise and fall until we get to that point where we have a vaccine. So, our current disruption is likely not the last or the end of the economic disruptions we're going to be dealing with. Another reason I'm pessimistic is that, there was some discussion that perhaps there have been a lot more people that have had this virus than we know. At some point you could reach what's called herd immunity, and then everyone can just go back to work because they perhaps won't be able to get the virus again. And yes, while studies have found that a lot of cases have gone unconfirmed, a couple early studies that I've seen have suggested that still the vast majority of people in the world have not been exposed to the virus. And so we're still a long ways off from achieving that kind of herd immunity, which again suggests that what we've seen in South Korea and some other places that the curve could start to rise again is still a concern.
Not to mention just the human toll of what it would take to reach that level of herd immunity, the number of people that would have to die to get to that point.
Right, absolutely. And a third reason why I'm pessimistic is, despite calls to reopen economies in our present moment, as the effects obviously are starting to bite and people are really feeling it. Another concern I have is whether or not, until again we have these medical solutions, whether or not people go back to normal, even if bans and quarantines are lifted. People are worried and scared for their health. And so you can just look at what's gone on in Wuhan, China, where many restrictions have been lifted. And yet there have been a number of reports out there that people aren't going back out to eat. They're not going to the movies. And so what we may find, especially in areas that have been hard hit by the virus, is that what's keeping people in isn't government regulations anymore. It's just fear and uncertainty. So to sort of wrap it all up, right, sustainability matters in terms of the economic response, because this is going to disrupt economies likely for a long time. And despite swift and historically large responses from governments, these may very well have just been down payments on what's going to be needed moving forward.
Is there a sign from the response so far that governments will be able to continue that historic level of economic relief for whatever amount of time it takes, for 6 months, 12 months, 18 months, however long before a vaccine is developed?
That's a really important question. I think right now it's still a little too soon to know. Most governments have really just started rolling out their big spending programs that they put together, and so they remain funded. The first real test has come in the United States, where we saw the Small Business Administration's Rescue Loan Program, this Paycheck Protection Program, which was part of the big $2 trillion emergency spending package put together last month. This PPP program was capitalized at $350 billion, and it already ran out of money last week, which just shows the intense demand that's out there for support for businesses. So Congress, of course, is right now debating how to put an additional $250 to $300 billion back into that program. But we've already seen, over the last week and a half, as this has been debated, some increase in partisan squabbling, right? Democrats are talking about, well, we need to also provide more support for hospitals and local governments. Republicans are wanting the focus to remain on businesses and complaining that money in the program is being wasted. It does sound like a deal is going to get done relatively soon, which is a good sign. But what you worry about moving forward is that with each successive round of debate over additional spending, whether or not that partisan rancor grows in the U.S. in particular, right? We're going to be getting closer and closer to a big election, and so we'll have to see what happens. I mean, what happens if, for instance, the airlines come back and need an additional bailout? What happens in that case? That's just one example of something that might come up in the future. So I guess I would just say the political will to address the crisis seems strong at the moment, but it's still really early. And I guess we'll just have to see what unfolds.
It seems to me that there's another element in addition to political will, which, as you point out, is important, but also trust in government, because this Paycheck Protection Program that you mentioned has also raised questions about how sturdy the government's response has been in terms of questions that have been raised about major national brands getting a lot of these funds while small and medium enterprises struggled to get noticed by the government. What does that really say about what people might be expecting from the government going forward?
I mean, the issue of trust is a really important one. We know that trust in government in democracies has been falling in recent years. And so to the extent that these responses are viewed as being, let's say, tilted to favoring larger companies and special interests, that's not going to help. I think one of the issues that we're seeing right now is that governments can put together these big programs, but the actual implementation, especially of a program like the PPP, comes down to the banking system and the banks. Of course, governments can provide these banks with direction. There has been some complaints, especially from smaller banks, that they haven't been getting that kind of direction from the federal government. But there have been delays and all kinds of issues with just the banks being able to actually follow through on rolling out this kind of a program so quickly. And so there are many moving parts between the government sort of spending package and when the money actually gets into the hands of the people who actually need those resources. So that's a whole separate discussion altogether, and it may not all sort of be the fault of governments for these things not working appropriately. But in the end, right, who are people going to blame if things don't work out the way they expected them to? Well, they're going to point the finger at governments.
There's a popular saying that I've heard thrown around during this crisis by political economists that everyone's a Keynesian in a foxhole. This idea that when you're in a crisis situation like a war, a natural disaster, or a pandemic, the deficit hawks turn into fiscal doves and big government intervention suddenly becomes much more popular. That certainly seems to be the case here in the U.S. now, but as you note in your piece, the stimulus package enacted by Congress in response to the last financial crisis in 2009 passed largely along party lines with only a few Republicans voting in favor. What's happened since then and now? Is it just that there's a different occupant of the White House, or has there been a deeper change in the conventional thinking among economic policymakers?
I think there's no doubt that the White House occupant matters here and matters a lot. Congressional Republican opposition to the American Reinvestment and Recovery Act, the 2009 stimulus plan, from my perspective, was less about an ideological commitment to fiscal austerity than it was a political maneuver to prevent a newly elected Democratic president, President Barack Obama, from getting an early legislative win. Right, this was just a month after his inauguration. Right, when that bill ultimately passes. So, Republicans in Congress today are far more supportive of big spending bills. I think in large part because they recognize that legislative inaction would jeopardize President Trump's chances at winning re-election in 2020, and by association, their own chances. So that really does matter, I think. Other things matter too. I think it's important to recognize the type and scale of the crises are different, right? In 2008, 2009, job losses unfolded, at the time quite rapidly, but in comparison to what we're experiencing now, those job losses unfolded far more slowly by comparison. And those losses weren't the result of governments requiring people to be sequestered in their homes. So we know the unprecedented speed that job losses have piled up over the last month in the U.S. and around the world. And so that absolutely has something to do, I think, with the greater level of bipartisan support that we're witnessing. It's just really an historically unprecedented moment. And then in terms of whether there's been some, overall shift, I think generally deficit hawks, the term you use, which is a good term, I think, they've been quieter in recent years anyway. And I think this is partly because despite ballooning U.S. fiscal deficits in the decade after the financial crisis, U.S. borrowing costs remain very low and inflation is nowhere in sight. And so that line of argument about the risks of spending too much and running large deficits, it's just not as convincing as it once was, in part because, we've seen this go on for a while, and the warnings haven't really rang true yet.
There are obviously key differences, as you point out, between what we're going through now and the last financial crisis. But that financial crisis is still the closest thing we have to a playbook or a model in the real world for how to respond to this. Where else have we seen treasury banks, central banks, economic policymakers apply the lessons from a decade ago to the current crisis?
I think maybe the most noteworthy response from where I sit is what's happened in Germany. This is traditionally a country where the finance ministry is dominated by the fiscal hawks who insist on maintaining budget surpluses. And the Germans are spending several times over their 2009 stimulus effort. And their current package is actually about twice as large as the U.S. plan as a share of national GDP. So I think that's a significant sort of departure from the way we might have expected Germany to respond in this moment. And, as I said in the piece that I wrote last month, I think throughout Europe and North America, we've seen governments collectively respond with historically large spending packages. Sort of the fiscal director at the IMF just the other day made this remark, saying that we've basically never seen anything like this from governments and central banks in terms of the size and speed of the packages that they put together. So it really is unprecedented. And I think that you probably don't get that to some extent without experience dealing with both the financial crisis as in 2008-9 and then the debt crisis in Europe. To pivot for a second to central banks, I think here the lessons are even more clear. The Fed has been the Federal Reserve, the U.S. Central Bank, has been without question, I think, the superstar of this crisis so far. In just a matter of a couple weeks, as things clearly started to develop in terms of financial markets and economic numbers sort of really stark, the Fed brought back and expanded its suite of domestic and international liquidity programs that it developed during the crisis 11, 12 years ago. It acted at the first signs of strains in international financial markets in early and mid-March. And so far, at least, I think these efforts have appeared to prevent this health and economic crisis from turning into a financial panic. So that's a really great sign. More broadly, beyond just the Fed, I mean, I think if we look at just central banks as a group in the 12 years since the financial crisis, we've gone from a world where something like a central bank asset purchase or quantitative easing, these kind of measures, were dubbed as unconventional monetary policy, sort of unprecedented experiments in central banking. And we're now in a world where, if we're being honest, these measures are now quite conventional. 10 years ago, when the euro crisis, debt crisis was unfolding, it was somewhat controversial for the ECB to purchase Greek government bonds. Last month, the ECB launched a 750 billion euro bond buying program, which was widely praised and quickly brought down Italian government bond yields. So, the Fed, the Bank of Japan, they're now buying corporate debt. These are unprecedented shifts. And, I guess what I'm trying to say here is that I don't think we see the Fed and other central banks respond so quickly with these kinds of massive liquidity programs had they not had the experience to sort of test out and develop these things in the previous decade.
I want to stay on Europe for a minute because I think this is a really notable space to watch where we could be seeing a potential replay of the aftermath of the last financial crisis where hard-hit economies like Italy take on tremendous amounts of debt in order to counteract an economic recession. And 10 years ago, the resulting bailout packages and austerity measures that were imposed on economies like Italy's by the EU fueled the rise of populist Eurosceptic movements across the continent. Now, to prevent this, there are rising calls right now for something called Eurobonds. A group of high-profile, mostly left-leaning economists signed on to this proposal last month in an open letter in the Financial Times. Tell us a little bit about what this idea would entail and why it's such a hot debate right now.
Yeah, so what they're talking about here is basically creating a system where the Eurozone can issue sovereign debt, borrow in international financial markets as a collective rather than as individual countries. And so the idea would be, if you lump riskier government borrowers together like Greece, Italy, Spain, if you lump them in with those that have sterling reputations like Germany, the Netherlands, and Finland, then borrowing rates for those countries that have high debt burdens, the countries that are sort of in the most economic trouble at the moment, that their borrowing rates would fall significantly because that risk is shared across the entire pool of Eurozone countries. And you could then limit or reduce the risk of falling into another debt crisis in the continent. Now, could it work? Sure, absolutely. I mean, it's completely plausible that this could be put together, and it likely would have those effects on borrowing rates. But it would require significant political steps that would sort of shift the Eurozone from something where it's mostly a monetary union into something a bit closer to a fiscal union. That's an idea that's been around and debated since 2010, at least, right? But it remains, at least at the moment, a political non-starter in those big Northern European countries that basically oppose this on moral hazard grounds. That their view is basically that Eurobonds would just encourage Southern European countries to borrow more, to continue to make bad fiscal decisions, while shifting the burden of these higher interest rates by comparison for those countries onto the more frugal parts of the Eurozone. So, for political reasons, I don't see it happening right now in the middle of the crisis. I think you might see continued debate about this moving forward as the Eurozone and the European Union continue to debate what their ultimate, what they're ultimately moving towards, whether they're stopping here or moving toward more integration. But I think a more realistic short-term solution would probably be to use Europe's existing bailout fund, the European Stability Mechanism, which is sort of a halfway house between national debt and the Eurobond. The ESM is basically capitalized and backed by all the members of the Eurozone. and it's capable of issuing its own bonds. And the interest rates on those bonds would be far below Italian and Greek bond rates, for instance. And it can then provide loans to those countries and pass on those lower rates. This was used in the past during some of the Greek bailouts. The concern here might be that the Germans and the Dutch and some of the other surplus countries would try to impose some degree of austerity on those borrowers in this present moment, which would really not be the right move right now. But realistically, this is probably the closest thing, I think, to Eurobonds that we're going to see right now.
You mentioned earlier the unprecedented actions that central banks in the US and Europe are taking that go well beyond what they did in the response to the financial crisis. Interestingly, we're not seeing the same level of firing of the fiscal or monetary bazooka from the world's second largest economy, from China, which has taken a much softer approach. Their stimulus measures, so far at least, have fallen well short of what Beijing put in place in 2009. What do you think is driving that change in approach on the part of policymakers there?
Yeah, this is a good question, and one I'm a bit puzzled by myself. China was obviously the source of the virus, the place where the negative economic impact was first felt, and yet, as you say, its fiscal and monetary response has been, on the whole, kind of paltry in comparison to Europe, Japan, and the United States. China is projected to have its first quarter of negative economic growth in over 40 years. It's kind of incredible saying that out loud, negative economic growth in China. The PBOC, the central bank, People's Bank of China, has cut interest rates some, and the central government has promised to increase infrastructure spending, but big infrastructure projects in China are hardly out of the ordinary. Part of the reason I think it seems like China isn't doing as much is because the banking system in China is just different than it is in Europe and the United States. Banks are effectively run by the central government. So there has been reporting that Beijing is putting pressure on state-run banks to ramp up credit to struggling businesses. In the West, governments are having to, pass legislation guaranteeing this kind of bank, which, is part of these stimulus packages. And in China, those guarantees have basically always been there. So we don't see this lending, as a new spending package coming out of China. So it's just business as usual. So that could be part of it. But despite this, there haven't been measures in China designed to encourage consumption like we've seen in the West and like China implemented back in 2009. And I'll be honest, I'm not exactly sure why we haven't seen that. Perhaps the CCP is betting that this kind of stimulus just won't have as much of an impact until the health crisis is solved. Maybe we'll see it later, and they're just sort of waiting for the health situation to get under control.
China's recovery played a very important role in the aftermath of the last financial crisis in helping the world recover. As Chinese demand picked up, it became an engine of growth in other economies. Do you think the big contraction that we saw, this historic contraction that you mentioned, and the potential long tail of a Chinese economic malaise, so to speak, could hinder the recovery from this?
Yeah, look, I think in a global economy where every economy is connected, and what happens in one part of the world matters elsewhere. Yeah, for sure. It's going to have downstream effects. China obviously is more important in terms of supply than demand when it comes to consumption, right? China, even though its economy has changed in recent years and consumption is up, it's I think the biggest effects of the shock coming out of China have been, factories closing down and companies not being able to sort of get materials through the supply chain in the way that they did previously. Once, production is back up, then those disruptions should stop. But for sure, negative economic growth in the second largest economy is not a good sign for global growth. You look at oil markets right now, right? The collapse in oil demand is, of course, a global phenomenon, but China is, the biggest energy consumer in the world, and negative growth in China is having huge ripple effects through oil and other commodity markets.
So overall, based on what we've talked about and what you've been observing in the world, what would you like to see more of from economic policymakers going forward as they plan the next steps of their response to this?
Yeah, so I'm going to point to three things here. First, I think it's time to get serious about infrastructure investment. borrowing rates in the US, Japan, Europe are historically low, in part because of these massive bond buying programs by central banks. Infrastructure projects would have the joint benefit of putting some people that are newly unemployed back to work and providing a long-term boost in economic growth. Some of the projections I'm seeing right now suggest that US debt to GDP could reach 117% by 2025. This would break the previous record set in 1946. I don't have to remind anyone what was going on in 1946 and why debt levels were so high. We're going to see historically high debt levels in Europe and Japan and the US moving forward. These debt rates are going to soar just about everywhere, but that shouldn't stop these big economies from borrowing now. Again, interest rates are super low, so borrowing is very cheap, if not effectively free. A country like the US in particular has more fiscal room than anyone else because of the dollar's global role. So continue borrowing, but that doesn't mean policymakers shouldn't be thinking about the long term alongside the short term. Borrowing to fund infrastructure investments makes a ton of sense because it addresses both short and long term needs. It puts people back to work, and it should help to speed up the economic recovery and promote long term growth when this crisis is over, which is going to be an important thing to think about moving forward. So that's the first thing. Second, governments need to do more, I think, to signal international cooperation. We're not going to get a G20 photo op today because everyone, including leaders, are sequestered in their homes, and you're not going to have folks traveling abroad internationally to a meeting in person. But it would be encouraging to see the world's big economies come together in some way with a communique to pledge their commitment to cooperation and openness in a big and meaningful way. I've given governments a pretty good grade in terms of their responses in isolation, but there have also been a lot of unhelpful protectionist measures over the last month, 6 weeks. Things like export controls. A friend of mine sent me an article from Global Trade Alert, which is an organization that monitors protectionist policies, and they dubbed some of these measures "sicken thy neighbor" policies, sort of a play on the "beggar thy neighbor" policies, which I think is a pretty great name for this. And it's not just trade. We've even seen in Europe moves to impose new restrictions on foreign investment. And just yesterday, so that would have been on Monday, President Trump announced he's halting all immigration into the United States, right? These kinds of measures could potentially further spiral into something even more ugly. One round of measures signals to other countries that you're on your own in this, and that's fueling arguments for those who have already been forcefully arguing that we need to have a global economic decoupling here. Some of this may be inevitable. It likely won't take government action to convince some firms to react to this pandemic by de-risking operations, like shortening supply chains, because they're concerned about the kind of disruptions we've seen.
Some of it is surely ideological too, though. I mean, our columnist Kimberly Ann Elliot, who writes regularly about trade issues, has a timely piece this week about a executive order that the Trump administration is mulling to bring supply chains from overseas to the United States, essentially to force companies to locate their supply chains in the U.S., and why that would be such a bad idea.
Yeah, right. Exactly. I mean, certainly some of it may happen naturally if firms think the risk is there, but you're likely to see this pushed by government policy as well, along these lines that I'm talking about, right? Using the current moment as proof for arguments that they've been making now for a few years, but saying, hey, this is the proof is in the pudding that this moment shows the risks that we're taking by having this interconnected global production network. And so, I think governments need to do more to signal and to actually, work to prevent policies that are going to lead to this descending into an all-out race to autarky. So that's the second thing. And then the last thing I'll say, which is on a topic we haven't really touched on, and that is major shareholders at the IMF, countries like the United States, Japan, China, and the big European countries. They need to collectively support an increase in that institution's permanent lendable resources. We haven't talked about the plight of emerging market developing countries right now, which are also reeling throughout this. They're dealing with historically large capital outflows, and they have large debt burdens that are increasingly difficult for them to sustain. Unlike the US and European countries, they're not able to issue debt in their own currency, and so they have some real challenges here. The IMF has taken some initial steps to relieve those debt burdens, which is important. More needs to be done there. But financing is going to be needed for these countries on an historical scale. There are reports already that over 100 countries have asked the IMF for support over the last few weeks. This has never happened before. The IMF has been around since 1944, so it has a long history. This has never happened before. There's no scenario I can envision where IMF resources do not come under strain as a result of this. As part of the $2 trillion spending package that passed in the U.S. last month, the U.S. okayed the activation of a temporary boost to IMF resources as part of what's called the new arrangements to borrow. That's important, but a big boost to the permanent resources is going to be needed, and that should be an international priority. The developing world is just as much a victim of this crisis as industrialized economies, and those resources need to be there to assist those countries. And in comparison to the massive packages being implemented in the U.S., Europe, Japan right now, the amount of resources needed to help these countries would be much smaller by comparison. So, a small investment with a big payoff. So those are three things I would point to.
Great points, all in all. Thanks so much, Dan, for joining us.
Hey, thanks a lot for having me.
Daniel McDowell is a professor of political science at the Maxwell School of Syracuse University. His latest article for WPR is What It Will Take to Save Economies from the Coronavirus Pandemic. That article is available for free at worldpoliticsreview.com, as are a selection of others from our COVID-19 coverage that we consider to be in the public interest. If you'd like to comment on the discussion, ask a question, or even suggest a topic for a future episode, drop us a line at podcast@worldpoliticsreview.com. Trendlines is produced and edited by Peter Dury. You can follow him and WPR on Twitter. And while you're at it, don't forget to sign up for our free daily newsletter. It's the best way to keep up with what we're publishing, and you'll also get a code for a 25% discount off an annual subscription. To sign up, go to wpr.pub/trendlines. That's wpr.pub/trendlines. Thanks for listening, and tune in again next week.